This is Matthew Cratter from Bitcoin University, and today I wanted to talk about exchanges running out of Bitcoin. This was a question: what happens when exchanges run out of Bitcoin one day? Where can people buy them then? And we're going to answer this question as well as some related questions in this video. So unlike grocery stores, exchanges, Bitcoin exchanges, crypto exchanges can never run out of their products. What happens instead in practice is that the price of the asset ratchets up enough to entice sellers back into the market. So if you think that exchanges will begin to run out of Bitcoin, what you're actually saying is that you're incredibly bullish on the fiat price of Bitcoin. And we saw something similar happen, similar market dynamics with a GameStop short squeeze in January of 2021, where you had lots of short sellers who needed to buy back to cover their GME shares that they had sold short. Did stock exchanges run out of shares to sell them? No. What happened instead is that the price ratcheted up to attract new sellers. And the price of GME in those days went from something like $5 or $6 or $7 a share up to $120 a share before crashing back down. If you're finding this video helpful so far, I just ask you to hit that subscribe button, hit the like button, leave a comment or question in the comment section below. A related question is, what happens if Bitcoin's price gets too expensive? Wouldn't that discourage investors from investing and thus stop its price appreciation? I think it's actually the opposite, because institutional investors, in my experience, prefer higher priced assets over lower priced assets because it allows them to deploy more capital at a lower cost. So in the traditional hedge fund prime brokerage model, if you're paying your prime broker, let's say a penny a share to buy stock, and you have a $10 million position that you want to take in a certain stock like Apple, would you prefer that each share costs $100, in which case you'd have to buy 100,000 shares, the fees would be $1,000, or would you prefer a higher priced stock where each share costs $10,000, you'd only need to buy 1,000 shares, and the fees, the commission would be $10. And so in practice, institutional investors that have a lot of capital to deploy prefer higher priced stocks. They certainly don't want to wade into penny stocks, for example. This same logic can also be applied to exchange purchases where the buyer pays a spread instead of a commission. We can take a look at Berkshire Hathaway as an example of a company with very high priced shares. It's never done a split as far as I remember. That has not hurt the stock. So here's the chart of Berkshire Hathaway, just gone straight up over the past few decades, because of course Warren Buffett likes to get his bailouts, and he got his bailouts in 2009 and 2010 as well in all his bank positions. But we can see here that this is an example of a very high price stock, and this is a similar price we'd expect Bitcoin to get to, $500,000 a coin, if it's going to match the current market cap of gold, for example. So here's an example of a very high price stock. It has not hurt Berkshire Hathaway's performance or its market cap, which is at almost $800 billion. And in fact, investors do like this kind of stock. There is obviously the Class B shares, which trade at a much smaller price. But nevertheless, here's an example of how having a high price stock does not hurt your performance. What it comes down to is that retail investors really are prone to what you might call unit bias. What really matters in reality, and what matters to serious investors, is the market cap and how that's related to the fundamental valuation that you've come up with. Unit price doesn't really matter. If you're buying a pumpkin pie, a whole pie, it doesn't matter if it is 100 slices or 4 slices. What really matters is the total pie, which is equivalent to the total market cap when it comes to corporations. Taking advantage of this cognitive bias was part of Ripple, the company's genius, when they offered 100 billion XRP units, because what this did is it really made each unit look very cheap, 39 cents a coin or whatever it is now, compared to BTC, because BTC only has 21 million units, and so the chunks are going to be much larger. But this is part of Ripple's conscious determination to take advantage of retail investors. Good news for Bitcoin investors, if you don't know it, though, is that you don't need to buy a whole Bitcoin. One Bitcoin is comprised of 100 million sats or satoshis. And so even if one Bitcoin were to become worth $100 million a coin, you'd still be able to buy one sat for $1. So satoshis will remain within everyone's reach, at least for the next couple decades. Now, what happens, a related question, what happens if your government makes it impossible to buy Bitcoin on an exchange, either a decentralized exchange or a centralized exchange? Could you still get Bitcoin? Of course you could, because you could sell some goods or services. You could work in exchange for Bitcoin. And Bitcoin is peer-to-peer money, doesn't require permission from a bank or government to be used. And so you could find a Bitcoiner, provide them with goods and services, and they will part with some of their Bitcoin at a certain point. Now, wouldn't a ban like this crash the price of Bitcoin if the US government, for example, banned Bitcoin? What happens in practice is the exact opposite. So when the US government banned both gold and marijuana in the 1930s, the price of each actually went up a lot. And this is because you get more scarcity when it's more difficult to find something readily available. Related question, what would happen if the new central bank digital currency, if the US dollar CBDC is programmed such that you cannot buy Bitcoin with it? Maybe you can't buy it on Coinbase or Kraken or whatever exchange is still around at that point. There's a very easy workaround which people use in developing markets as well with the US dollar equivalent. You basically take your US dollar CBDC, you buy something that is allowed like groceries or a lawnmower, and then you sell those groceries or lawnmower directly to a Bitcoiner for BTC. So this is not a way of stopping Bitcoin. Finally, I wanted to end with a very interesting tweet exchange between Ray Youssef and Saif Ammous. Ray Youssef said on September 3rd, the higher the price of Bitcoin, the less people want to spend it and the less chance of circular economies. When enough of it is hidden behind bank walls and KYC, then the price could be $1 million and it wouldn't matter. And I think Saif has the correct response here. Respectfully, Ray, it's the exact opposite. The higher the price of Bitcoin, the more people will want to spend it and accept it, and the more likely they are to find others willing to accept it and spend it. When the price rises, the size of cash balances held in Bitcoin increases so that people are more likely to spend it. Also, the more the price increases, the more cash balances of it exist out there. And I think that's a key point. And the more likely you're going to run into someone to accept it or send it when you're trading. Think of the opposite case. If the value of drops, if the price of Bitcoin drops, there's less and less to spend, and fewer people who have it in their cash balances will be willing to accept it. People spend what they have in abundance. I think that makes a lot of intuitive sense. Things become money because people have them in the most abundance. Without a giant amount of it held, it can't be money. If Bitcoin is at $1 million, that means it's almost as big as the US Treasury market, which means that everyone in the world is holding as much Bitcoin as treasuries, and that makes it inevitably money, as almost everyone holds it and is using it as their cash balance and is willing to pay and receive payment with it. I think it's a really interesting result. It's a little bit counterintuitive. You'd think the higher the price, the less people are willing to part with it. But we've seen this certainly in tech companies. The higher the price of the stocks, the more expensive houses people buy, the more they spend on fancy groceries and private jets, etc. So there's something very equivalent here with a high market cap for Bitcoin and a high market cap for a tech stock. If you enjoyed this video, be sure to hit that subscribe and like button. Hit the notification bell if you want to be notified when I publish my next video. And let me know your questions and comments in the comment section below. Thanks a lot for watching, and I'll see you in the next video.